right. Why don't we get started? So we're just at the top of the hour. So welcome to our third real estate colloquium that we've had in SOM. And this one is a special one in that it's joint with Center on Business and the Environment to talk about a very hot topic, just based on all of the conversations I've been having with students lately at SOM and YSE. And today we're going to be talking about green property retrofitting, and particularly the challenges that and opportunities that we face for doing these green property retrofits in a post-COVID world. I think a lot of you know me. I'm Cameron LaPoint. I teach our real estate course offerings at SOM, and I'm just going to kick off with a little bit of food for thought and data, and I'm going to turn it over to our moderator and panelists to discuss for the rest of the hour. So, okay, there we go. So, why are we talking about buildings in the context of the climate crisis? So it turns out that building operations account for a very large share of the gigatons of carbon that are emitted. So this is a slide that's just from the International Energy Agency that did a report last year showing the breakdown across residential and non-residential properties and direct versus indirect emissions, that in total building operations account for a quarter of global energy emissions. And if we were thinking about these net zero emissions targets, trying to reach those by 2030, we would need to reduce the output year on year of carbon emissions in the building sector by 10%. So, we have a lofty goal if we're trying to meet this net zero target. Now, on a brighter note, we have some case studies, including just in our backyard. It's a picture of the Hotel Marcel, which I think many of you are probably familiar with, and we're lucky today to have the architect and developer for Hotel Marcel, Bruce Becker, who's going to be talking more about that as we go along. And you might have seen the recent Yale Insights piece talking about the innovations in green financing that went into the development of this hotel. So this is just a slide courtesy of Bruce himself, and that's detailed in that Yale Insights piece. And I've highlighted in here some of the new green financing initiatives that were used in order to build this property, which is very unique in the sense that it's the first net zero hotel. And so just to kind of highlight as food for thought for the discussion later on, this is subject to a 30% federal tax credit that was built into the incentives for the Inflation Reduction Act. We also have CPACE funding to the tune of $6 million that replaced traditional equity. And we also have a local utility grant for $400,000. Now, when you add up these line items together, Bruce and his team were able to lower the equity requirements for this property by $3 million. Okay, so there are a lot of incentives out there, a lot of public-private partnerships that are going into the development of these net zero properties going forward, and we're going to talk about those as we go along today. Now, what is this CPACE concept? So we're very lucky to have one of the co-founders of Nuveen Green Capital and Greenworks, who really spearheaded in Connecticut and then beyond this new type of financial contract designed to offer lending for green energy and climate resilient investments. And so we'll talk a little bit more about these as we go along, I'm sure, but the way you should think about this is that there's an implicit government backing and that the loan gets paid back through the local property tax bill tied to that building. And so there's relative to traditional commercial real estate loans in the space, there's a longer payback period. And as you can see from the figure, this is a very large segment of CRE lending now. So if you were to combine both commercial and residential real estate that has benefited from PACE financing, we're now at a total of $15 billion as of midpoint of 2023. Now, this is just a bit of thinking not just about commercial, but also what individual home investors are doing. They also can, in some states now, qualify for PACE financing. And it's not all just energy efficient advances that we're making. It's also thinking about climate risk in terms of storm exposure. So if you just looked at, for instance, in Florida, which has experienced some very heavy hurricane seasons recently, if you compare this first pie chart, which is all permits for residential properties in Florida from 2010 up till today, about half of that pie is just basically kitchen renovations, okay, so non-green home investments. And if you look at the ones that qualified for PACE and filed permits, well, then you see that the composition has changed dramatically. So a lot of these investments that are being made with PACE financing are for things like window and door impact-resistant roofing, re-roofing, solar. Okay, so even at the individual homeowner level, we're seeing a lot of advances in this space. Finally, and kind of putting this together in the macro and financial environment that we find ourselves, many of you have probably heard about lock-in effects, okay? If you're trying to get a home right now, it's very difficult in that if you went 2 years ago to your lender, you could get a mortgage for 2 to 3%. Fast forward to today, rates in the market are 6 to 7%. So if you compare where most existing home loans are, they're in this sweet 2.5 to 4% region, and today you're at this red line. Okay, so what does that mean? It means that people feel locked into their properties. They don't want to switch out their existing home mortgage at the low rate for a new home loan at the high rate. And that's also happening in the commercial real estate space as well. So if we think about this lock-in, it also gives us an opportunity to redevelop that property. And so on a lighter note, if you were to think about which properties in the country are ripe for some of these conversions, we know there's also a critical need for building more multifamily. Okay, we have a housing affordability crisis. This was the subject of our fall real estate colloquium. And this is a very interesting report that's now reached the White House that's joint with Hamilton and Becker's project, which shows across the country which are the properties that are ripe for conversion from office to residential. I just want to highlight 2 things, and then I'll turn it over. The first is that this is not just a population-dense city phenomenon. So these dark bars here are for New York. The light bars are for the rest of the country, and so you see there are a lot of properties ripe for these conversions outside of New York City. And the second thing is that it really depends on what the age or the build year of the property was. If you have relatively new properties that were built in the 80s versus some pre-war properties, those are going to be easier to convert than others. And so I think this highlights both the challenges and the opportunities given where we are today. And so I'm now going to step aside and leave it up to our moderator, Stuart DeCew from Yale School of Environment and Center for Business and the Environment to introduce our panelists and kick off the discussion.
Cool. Thanks, Cameron. And really appreciate the connection here, across schools, and then we were able to curate this. Cameron's done a wonderful job of setting this up. Just appreciate the global train station that you're in, and then all of the kind of people who come through it and their talents. This is a panel that we just get to put up for Yale alumni that could be at a major real estate conference across the country. And so you've got Bruce. Bruce is in the midst right now trying to wrestle the global hotel industry into net zero because he created the first net zero hotel right here in the backyard of Connecticut, right? And when you look at 360 State or you look in Hartford at big conversions of different types, Bruce has been on the leading edge of all elements of sustainable architecture in Connecticut. You've got Jessica. So when that chart on CPACE was there should be a smiling picture of Jessica and Ali Cooley when it's tiny. And the 2 of them essentially created an asset class. So if you're wondering, what does an asset class look like? It's actually sitting right in front of you on stage. And, she can tell you all about, every difficult part of making that happen at an early stage, which includes, door to door, walking around and knocking on municipalities in Connecticut. And then you got Brian, who has kind of at a stage where impact investing was this weird nascent word coming out of SOM and you were learning about it, then took that and put it into practice at the edges of neighborhoods and in places that no one else really wanted to think about or go or kind of invest their time and energy, learned about it, and then has created platforms to teach other people about how to do that and how to make that happen. So this is where the people who really think at the edges of things come together and are able to figure out the toughest challenges in real estate. All right, so they're going to have a conversation. I'm going to shut up, and we're going to ask them questions, and then they're going to probably probe and check with each other on things. But you all will get some time at the end as well. If you have questions, you can use a QR code, but we're an intimate crew. You can submit those and use it if you're digitally inclined, but please just raise your hand at the end, and let's have a conversation as well. So I'll leave that up for right now. We're going to give you some information on the courses that are there too. But there we go. All right. So Bruce, let's start with you. It looks simple on a spreadsheet when you kind of put it up there and say, here are all the components of how we do a retrofit at the Hotel Marcel. But can you kind of walk us through an outline sort of from a deep expertise in kind of building technology, architecture, and development? How do you make one of these retrofits and conversions come together? What are the components of it, and who are you involving in this process? Who are all the people that kind of get involved in an effort that is this complicated, nuanced, and challenging?
Good question. I had just There was an earlier slide that talked about this carbon problem that we're facing globally, and that commercial buildings, and actually all buildings, are a big contributor to that, and that their operations are contributing, 26, 29% of the problem every day. But also the embodied carbon in buildings is also a big part of that. So in terms of the opportunity with retrofits, you can look at it a couple different ways. I think if we look back at this period 100 years from now, we'll think, how did we not realize that building new buildings was going to be so damaging to our climate and our environment? And why wasn't everyone just retrofitting existing buildings? Because we now know how to make buildings that don't use any operational carbon. You can have all electric buildings. I've yet to see a single building that can't operate entirely from electricity. So we know not to use fossil fuels. But the process of making the buildings is carbon intensive, except for retrofits. Retrofits, if you can reuse the foundation of a building, the structure of the building, you can have a very light intervention using low carbon embodied materials. So the question is, how do you do that? And I think SOM equips students well to have this interdisciplinary approach. It does require sort of looking at all the disciplines together. And but basically just doing things based on principles. One principle is, let's not use any fossil fuels. How do you finance it? How do you build it? I mean, there's a lot of advantages to financing retrofits. If it's a building that has any historic significance or cultural significance, you can access the federal historic tax credit, which was a big part of the last two projects that we've done. And that can pay for as much as 40 or 50% of the cost of the building if you pair it with the state credit. And then there's the IRA, which if you're using low carbon systems, that will help you. And then CBEY is sort of the new magic tool that Jessica has been talking about that has enabled it to work. So I actually believe it is more economical and less expensive to go this route. The problem is that a lot of people in this real estate industry are doing things the way they've always been done, and so it's taking a while to shift and learn new things. This is the advantage you guys have in this laboratory of Yale, is to go out into the world and bring these new ideas and implement them. But just to summarize, I think you just have to have a principled approach to your work, take an interdisciplinary approach, because it's really no one's job to not use carbon. Sometimes you're starting to see like departments of decarbonization, but that's still very rare. It doesn't really exist in the hotel industry or a lot of commercial real estate organizations. But I think it's actually easier to do, and it all depends on the specifics. If you think in an interdisciplinary way, you're willing to take and bring in design talent and financing talent, I've actually found it to be easier to do than conventional development. That's it for the answer.
Great, thank you, Bruce. All right, so Jessica, you've just been called the magic tool. So I don't know if that's like a trademark term for CPACE, but can you describe like what you and Allie and the rest of your team built? Like, what does it mean to kind of create this asset class? What does it unlock? How does it help building owners, developers like Bruce? Like, what does this do overall, and how does it change the dynamic of the way people are thinking about investing in real estate?
Yeah, so it sort of started with that chart, right, that showed that if you care about climate change, you've got to care about buildings, because that's where a lot of the carbon comes from. And then you start to realize that not everyone is Bruce Becker, and most building owners and developers and architects aren't going to take that principled approach necessarily at the outset. They're just not. They're going to be focused on their bottom lines. So then you very quickly get into a situation where you've got to figure out a way to help a building owner solve not just their carbon problem, but their economic problem. And that was really how CPACE got started, right? So CPACE is, at its core, a public policy, and I won't give everyone a policy lesson here, but the policy is super simple. It says energy upgrades in our state are a public benefit. That is the magic. Those are the magic words. And by passing that policy here in Connecticut and in 30 some odd states around the country, what we do is we unlock the power of the government to secure financing into commercial real estate for clean energy upgrades. So it allows us a mechanism to finance a retrofit of the Hotel Marceau or a new construction project that's going to be built above code. And we can secure financing as the lender through a tax assessment placed on the parcel of real estate payable over 20 years. So it sort of marries commercial real estate financing, sort of the traditional mortgage finance, with municipal bond finance, the way we've always financed sewers and sidewalks and firehouses, the way we finance the infrastructure of this country. And it puts it together in a way that can help building owners combat climate change without sacrificing their bottom line. So that's really what it is. Allie and I started a company called Greenworks Lending out of the Connecticut Green Bank. Some of you guys might be familiar with that. It's like the first public-private partnership in the state of Connecticut that became a real, like a contagion effect. There's a bunch of them now around the country, which is super cool. But we realized at the Connecticut Green Bank that if we really wanted to have an impact, no offense to our wonderful little state here of Connecticut, we were going to have to do it in a bigger place. So we moved into a private company. We founded it in 2015. We built it up in 2021. It was acquired by Nuveen, which is a $1 trillion asset management company, and a real endorsement by Nuveen to say, hey, this is a type of financing that we care about. We think we can pour billions of dollars into buildings through these structures that you guys are creating from this public-private partnership. And so that's what we do. We lend money across the country to building owners who want to build a new construction project and do it with equipment that is going to make the building perform above energy code. Or with developers like Bruce to think of, hey, this kind of weird esoteric asset that is going to be around for a long time, what can we do with it? How can we create a financing solution for him to do his magic, which is to figure out how to electrify a hotel and try and transition that industry. So we played the role of providing capital for that.
And quick follow, does like PACE serve as a gateway drug to create more Bruce Beckers? Like, does it like, do you end up like getting them seated and then you see people begin to like take hold?
I want to say yes, because this is a room of, idealists, I hope. It doesn't. When I think of what we do is like stealth sustainability. We kind of create a product it's a good product on its own. Whether you're financing lollipops on the roof or solar panels on the roof, it's a good financial product. So the fact that we can use it to help building owners stretch a little bit farther feels good to me. But I don't personally think that we're the gateway drug. We're not the reason they're doing it. We're making those guys and gals that want to do it have an easier time convincing their CFO that they should. And we're sort of like the arbiter of the negotiation, something like that.
Great, thank you. So, Brian, when you were a student here, you toured Bruce's buildings and looked around. You've actually used PACE financing in some of your development scenarios. And you're recently going through kind of a very innovative project in Newark where you're converting a commercial property to a residential property, accessing all sorts of different capital platforms that you've created, opportunity zones that are in that, sort of federal tax credits. Like, you're layering all these things together. And from what you write on LinkedIn, it's really challenging. And there's lots of things that fall apart and go wrong and you're dealing with. Can you talk about kind of in your role, what you do at Shift Capital and then how you navigate and kind of manage a project like this or projects like this where you're really focused on changes in urban areas?
Yeah, well, first off, it's really cool to be here at us when I'm talking about CPACE, not just the connection of Bruce when I was a student, but also, talking to Allie in her early days at Greenworks, watching that come to Pennsylvania, being able to do the first CPACE program, a project in Pennsylvania. And it was in a neighborhood that had an average median income of $22,000. So it was really rewarding. And I do think, and I want to say, before I jump into that, just to say, I know you wanted to answer that question, like, yes, that's right, now we create all these Bruce Beckers out in the world. But actually that is part of the secret sauce because 99% of developers are just focused on bottom line, whether they're small or large. And so making something that backdoors into impact by creating a product that actually means that I have to put out less money is the brilliance of it, actually. And so, look, it's interesting to be on this panel because I'm usually not on an environmental panel, to be honest with you. Usually our focus is, that we're trying to create equitable neighborhoods and underserved places that a lot of investment's not coming in. But whenever I get the environmental question, I always say, but we're investing in urban neighborhoods on public transportation And no, I'm not doing LEED certified buildings, but I would argue that probably what we're doing is just as impactful environmentally. So, you know, the work that we do, I say all that to say that the work that we do is already super challenging in a different way than what Bruce's challenges are. Our capital stacks, you know, we're doing a hotel in Philadelphia, a Marriott Courtyard, that probably has, I think, 12 sources of capital, from historical tax credits, new market tax credits, you have a state grant, we have the CPACE equity on that, and that deal is falling apart, right? We have this deal in Newark, New Jersey. We were doing an office to resi conversion, which I'm sure we'll go into in more detail. And a very well-known bank, I don't think it matters, as PNC, basically brought it through committee, approved it, and then this was all before Silicon Valley fell apart. They decided all of a sudden they needed to bring back to committee, where they denied it. And the last 2 years have taken the challenges of the real estate space and have just like magnified the challenges of pretty much everybody's work. Interest rates, construction costs, you know, banks have really pulled back from, you know, from doing maybe projects that they would have done in riskier neighborhoods. So everything's about de-risk, you know, everyone's de-risking right now. Well, what does de-risk mean? It means that basically you're going into the core of cities and places where Class A and all these things already exist. So from my standpoint, you know, one of our missions is on that environmental justice side, right? How are we bringing in and pushing the envelope on retrofit strategies, whether it's on the finance side or talking earlier with a student on the technology side. But we are unique, and I just want to underline that in the sense that if we say 99 out of the 100 developers are not Bruce, or you go into lower income neighborhoods, and I would say 999 developers out of 1,000 are not putting on an environmental hat unless you're doing what CPACE is doing, which is solving some other financial challenge that happens to backdoor to some environmental impact. So the work, you know, part of our kind of larger work is trying to raise awareness of what it means to do retrofitting in lower income neighborhoods where the numbers already don't work. And so how do we create better mechanisms? And while I love CPACE, at the end of the day, it doesn't actually shrink my uses, right? It's not a grant. So in fact, to some degree, some of the challenges to it as you get into other areas of the business in urban neighborhoods is you get stuck with adding leverage to your capital stack, which obviously then creates, and your equity becomes even riskier, right? And has a chance of getting wiped out. And so there are pieces of this that I think are still in the nascent stage where, to Bruce's point about, you know, where you guys all are right now and where you're coming out, we're in like inning 2, right? I won't say we're in first inning, but we're definitely in inning 2 of a much bigger discussion about how to solve that. And the big things like PACE have now made it, you know, all of a sudden Nuveen and, you know, BlackRock and all these other institutions are starting to look for larger scalable, you know, opportunities within space, which is, I think, a good thing overall.
Can I
Go ahead.
comment one thing, Brian?
Totally, that's what we're here
I
for.
think that Jessica actually can reduce the amount of money you have to raise, particularly when you pair CPACE with these new IRA incentives. For example, if you put geothermal heating and cooling into a building that is in a low-income area that has a brownfield, and you source that system from domestic products, you can get up to a 70% tax credit on the entire mechanical system for your building, as well as the solar panels, which allow you to have free electricity. And then you can, not only get that 70%, but then you get 100% of that from Jessica. So you actually have a net reduction in the total capital you have to raise. But I think you have to sort of look for these. Every building is different. Every energy system is different. The utility prices in one place may be different than in others. Some utilities have incentives they can supplement with that. Right? I mean, as someone who was a joint degree student here at architecture as well as at the management school, I've always sort of been thinking, is there a design solution to a financial problem, or vice versa? And I think as long as you're sort of looking at things as a zero sum, you might overlook opportunities. Sometimes if you do more, it costs less, which is not, sort of counterintuitive.
Thanks for that. And Jessica, can you tell us what inning 4 and 5 looks like? What are the broader trends that we're seeing? You've grown an asset class through COVID and now post-COVID. You're talking to all these different building owners and asset owners. What does it look like from your perspective on how they what are the emerging trends and things that you're seeing?
Sure. So CPACE has had, I don't know how many innings, it feels like a million, but it really started as a tool, a financial tool to renovate existing buildings. That was the idea of it here in Connecticut. It was to go, we had the number sometimes 20,000 buildings that were of the right size that we thought we needed to go in, retrofit using CPACE financing, and we could drop the emissions of those existing buildings. So that was kind of where we started. Boiler swap outs, HVAC systems, blown in insulation, kind of really, I always say it's really boring stuff. It's the stuff in the basement, the stuff on the roof that, we try and do a ribbon cutting and get the media to come and they're this is super boring.
It's not boring. You can go tour the Hotel Marcel. It's very cool.
This is inning 2. Inning 1, trust me, it was boring. The first year we did in Connecticut, we literally invited the governor to come. It was in Norwalk. It was a strip mall in Norwalk. And nothing had happened yet. I think that they maybe pulled the old boiler out of the basement and it was sitting in the parking lot and the mayor and all this press show up. Where should we do the photo op? The first CPACE project in the state of Connecticut. And his PR team's this is horrible. Nobody's going to want to do this. It looks so bad. But eventually we put the photo there and they took a nice photo. But it's, that's the stuff. That's where climate change is happening, right? That's the energy. So that was kind of inning 1. Inning 2 for CPACE was new construction. So we thought, aha, if we really want to kind of expand our impact, let's not just think about all the buildings that we need to retrofit and not to discount them, but people are still pouring cement here. People are putting new construction projects into the ground, and we should make sure that we are creating a financial product for them to make sure that they're able to think beyond just what the building code tells them they need to do, and think about putting in solar, think about putting in building management systems and high efficient HVAC. And so we moved into new construction financing. That had 2 effects. One, we obviously started seeing new construction projects with hopefully lower emissions, but it also dramatically increased the deal size that we were doing. So if our retrofit business was sort of $600,000 boiler swap out, our new construction projects started to look more like $2 to $10 million capital stack plugs. So kind of what you're talking about. So we're coming in there and we're swapping out what would have been additional equity required or a kind of mezzanine financing structure in there. And we were coming in with bigger checks. So that was fueled a lot of our growth. And then COVID hit. I was like, oh shit. Nobody's doing anything, going into buildings, now what are we going to do? And when you're an entrepreneur and you're a startup founder, you're always trying to be scrappy and think around the corner and figure out how you're going to survive, and COVID was no different for us. What we realized is that the law in most of the states we were operating in said that we could retroactively finance building owners who had done a clean energy upgrade on their building over the last 2 or 3 years. And we still don't know who gets credit for thinking of this idea. I'd have to dig into it. But someone on the team said, well, why don't we just start marketing CPACE and sort of a recap financing opportunity? And the piece of me that cares deeply about climate change was that doesn't feel totally mission aligned. This works, there's no additionality here like that. But the business hat then comes on and you've got 100 people whose paychecks you're responsible for signing, and you think, all right, well, this will work. So we did that, right? So that during COVID, it was really about recap financing. So building owners really, frankly, taking our money to cash out usually equity that they would put in to renovate or do something to their building. So that was inning 3. Inning 4 is now, and we're doing a mix of all 3 of those types of financing. The good news for CPACE is that it's very malleable. It sort of works in any market environment. Last year, which was a really tough year for most real estate developers because the capital markets froze up, we at Nuveen and within CPACE were able to really fill parts of the commercial real estate market that regional banks were pulling out of because they were worried about construction lending. Debt funds were unable to kind of find anyone to buy their notes, so they were kind of pulling out of the commercial real estate construction market, and CPACE kind of flooded in. So it gives us a bigger microphone to talk about the things that we care about, which is, hey, if you're using this financing, you actually have to do things that are a little bit further than you might otherwise have done. So that's kind of what this feels like to us. It's a little bit of everything at once.
Very nice. And Brian, so what does it feel like to you? You know, you've got like some of the broader trends, like hybrid work is here. You've got sort of challenging commercial real estate in many urban environments. People haven't gone back to work fully. You've got some areas where we just haven't built enough residential capacity so that normal people can live in places close to where they work. What are you seeing as a developed return of these broader trends and then the interest environment that people are seeing right now? Like, what could happen and what needs to happen to address some of the things we might see in innings 7? We'll keep going baseball. 7. Yeah.
I mean, I think that I'm kind of at the mindset it's yes and, right? So it's going to be a combination of things. I mean, we started off with this conversation about an office resi conversion, and there's New York Times articles and billion-dollar funds getting raised. The reality is, when you really scale back and start to look at office to resi conversions, it's such a small part of the marketplace. And as far as the number of units we need to add annually, I mean, I have the stats, but it's less than 10% of all office buildings are even going to be remotely possible to do it in. And then the factors of who's selling it, the basis, all these other things come into it. And that's largely a fewfold. It is basis, right? So a lot of these large office deals are we need the loan to be taken back. We need a whole reset before it could become eligible from a financial perspective for a resi conversion. There's the physicality of office buildings, which I'm sure you're paying attention right into that. So that's a sliver, right? The other things that we're paying attention to are, modular. I think generally, also not the end-all be-all. It only works in some places, but I do think the modular world is evolving, and I think is going to play a huge role here long-term. Building materials. I mean, I think Bruce could expand on this at length. There's really some incredibly fascinating material, advances that a lot of innovative, entrepreneurs are doing right now. That I think one or two of them are really going to hit the big time at some point. And then, as tech, whether it's the plugged-in building from a livability standpoint, that matters, but also the HVAC system, the boring guts of buildings, right? It's the mechanical engineers who are going to come up with, game plans that are going to make it, hey, I'm a developer who doesn't necessarily care about impact, but I've got 2 options now in my building to replace that boiler, and they pretty much cost me the same thing. And this one improves my, the costs for my tenant, it reduces bills by 90%. And spoken like most developers, I can pick that back up and rent, right? So when those financial equations start to get to places that make sense, that's also, I think, going to be a big part of it. So those are the 4 or 5 things that we're looking at and saying, okay, who's doing what is that going to look like? Where can we start to incorporate and pilot some of that stuff? Because the other thing about even our CPACE, we were the first one in PA. It was also actually with a SOM grad, Mary Rose, who we were talking about earlier.
Who's Mary Rose? We've got if there's any reference or term or kind of building technology you don't understand as well, like we'll be able to find it. But Mary Rose is who?
She is an SOM grad who now runs the Philadelphia Green Bank.
Yep.
And was part of the early kind of CPACE application in Pennsylvania. But it was a disaster. Like, it was a pain in the ass. We were the guinea pig on all the docks in Pennsylvania. And I mean, you've been through this 1,000 times. So that experimentation, is where we want to play with our work, so that hopefully we're now ahead of the curve for the second, third, fourth time around, where we can really start to hit efficiencies.
So to put things back in context and zoom back a little bit, Jessica was at the early stages of the creation of the Connecticut Green Bank, building this new asset class. Brian is interacting with an SOM alum who's creating one in Philadelphia. There's an SOM alum at the EPA who's designed the entire federal green bank process system, the GGRF, named Jockey Wise, where they're going to distribute $27 billion across the country in this. Like, the place
What's
you're
your name,
sitting,
Jockey Wise?
Jockey Wise, who's a law school and SOM grad. The place you're sitting in is like the kind of interconnected center of how people are trying to redesign the plumbing of green finance in buildings. Like, all of these weird people at edges who are like, I don't think that anything in this makes sense. You know, people like Bruce, who in '85 like founded the real estate club because it didn't exist here, and like saw that design and finance and other things needed to come together. Like, I've been doing this a while. Like, there's a huge network to dig into that this is just representative of.
I will say, I hear all the time they're like, oh, are you part of like the Yale Clean Energy Mafia or the Yale, you know, there's definitely, wherever you go, you'll kind of self-identify and find people. I will just say though, because I feel like it wasn't that long ago that it was like the documents are being written, and there is something that is, it sounds very gloried or storied when we sit up here and talk about it. But I think the people that have gone to the places that you're talking about from the seats you guys are in now are the ones that like walked through the hard yards and did, you called it experimenting, I like that. It's a grind, right? So trying to create something that doesn't exist or change the way people do things when they've been doing the same thing and it isn't totally broken if you look at it in a certain way, it's hard and it can be super frustrating, and you can feel like you're making such incremental progress that it doesn't feel like you're having an impact, but then you scale up and you look and the way you're talking about, like, no, there's pockets of this that actually are transitioning the way we finance clean energy, the way we build buildings, the way we think about impact. So it's cool when you think about an aggregate, but it's hard. It's just really hard, to be clear.
And so Bruce, kind of let's dig in on the hard work here of how, like, when you think about the experimental partners that you've drawn into these projects and where you've kind of taken and said, okay, we're going to build the first net zero building or net zero hotel in the United States, and then I'm going to go to the hotel chain and try to get them to pay attention and figure this out. Like, who do you have to pull in and what do you have to do? Like, what are the strategies and approaches for changing mindsets?
I think it's just deciding that you're going to write your own book. You know, that you're. It's very easy to leave here and see what someone else has done 10 years ago and say, well, I want to do that, and just do something that's been done a bunch of times, and maybe you can, at least in the short term, make more money doing that. But I think what's more interesting and what will lead you guys to be innovators is if you question every single thing you do, and maybe you do something that no one's ever done before. For me, there's nothing. There's really no genius in what I've done. It's just like there's 3,000 decisions you make when you build a hotel, and rather than just following a playbook that had been done before, I just thought, well, gee, we want to use fossil fuel, so is there a way to have a commercial kitchen that uses induction ranges instead of having fossil fuels burning all the time? And look at all the benefits of that in terms of the health of the employees and the or is there a product out there that will make domestic hot water without fossil fuels? And in fact, it was Mitsubishi was marketing this product in Europe, and I got them to sell it here. How do we reduce our energy use? Some of the things. So it's really just slogging through every day, making 10 decisions a day for 300 days, and then by the time you've done that and you follow some basic principle, and you're willing to sort of make 5 calls instead of just one, you'll get really good consultants, find people like Jessica that knows what she's doing to help you, and but there's nothing that we did that hasn't been done. We just sort of sought out people and technologies and systems. I had never done a hotel before, so I took a certificate program at the Cornell Hotel School because I didn't know what some of these acronyms like FAR were that, if you want to get a loan from a bank, you need to know. So maybe the most important thing is to know what you don't know and figure out what that is and get people to advise you. But I think it's having a curiosity, which obviously I can track all of that back to this institution where I was exposed to ideas and wanted to learn more. And if something's not being done, figure out how to do that. I mean, those of you who are involved in the real estate club, if there's something new, get to know someone who's involved in that and learn from that. So, learn.
I'll just jump on and say something you said resonates is pay attention to Europe, right? In this space, especially in the built environment and especially on the financing side. The many European countries are so far ahead of us when it comes to financing strategies, direct bond issuances, things that we're really talking about here, but not really doing at enough scale. And then I think obviously on just the buildings themselves, technology is incredible.
I built everything very efficiently. Still, the dryers in our laundry were using a third of the energy for the entire building because no one was selling heat pump commercial dryers in the U.S. So I call every month too. I call folks in Sweden at Electrolux. I said, "Wow, there's a huge market. The laundries are using about 25% of all of the energy for hotels in the United States, and there's lots of them. If you would just sell your heat pump dryers, everyone could actually have some hope of meeting that trajectory of reducing their energy 10% a year for the next 6 years. And so finally got them to do that. So we have the first two in the United States that are just being commissioned.
And how quickly do those pay off?
They pay off like in 6 months. I mean, it's crazy. The energy that we're using now, we have two, or until last month, we had 2 dryers using 126 kilowatts, 8 hours a day, every day. I mean, that was like more than our solar panels produce. And now we have heat pump dryers that use 6 kilowatts each room. And so it's just dramatic. But these are, until you actually start looking at the numbers and sort of try to reach your goal, I mean, you just do what's been done before, and you can't innovate and you can't come up with a better approach. And the crazy thing is that this saves us a ton of money, and it can be replicated. So what I'm trying to do now is, because it takes 4 years to do a project, I'm now just trying to share these learnings that I've had so that suddenly the whole hotel industry can shift. And actually, it can shift within a couple of years. They could actually meet their targets if they're doing that.
There's a big sexy opportunity on commercial heat pump and hotels. Like, if you're not interested in that from like the school management perspective, like please go work for Electrolux and sell that across the United States. And Europe is 10 years ahead of us. And if you talk to anybody here from Europe? No? Yes? Like you mentioned heat pumps to somebody in Europe, dude from Northern Europe, they're like, what? That's a big deal in the United States? Like, what are you talking about? Like, this is a technology we always used and it works forever. So, like, there's lots of things you can pull from. What are your questions? We have wildly creative, smart people up here. We've got a little bit more time. What do you want to know? Yeah.
Hi, my question's for Brian. My name's Emily. I started my career in real estate banking, more in syndications for commercial real estate, switched to the developer side, especially because you're working in lower middle income neighborhoods. Was curious if you've seen anything from the Community Reinvestment Act changes or how they're reinforcing that in terms of regulators, and then how banks are pushing back on that, if that affects your business.
I mean, I would say a large chunk of our financing ends up being CRA driven. And as you probably are paying attention to, there's been, a bunch of changes and conversations around changes. It really, from our perspective, it hasn't changed. We haven't seen huge changes on the ground as it relates to CRA investment. I mean, I think banks are honestly doing what they've always tried to do, which is do as little as humanly possible to meet the requirement in deals that otherwise would not be any more risky than if they took them. That's my very cynical, path. But I do think you're on to something, and just in terms of as we look out over another couple innings, sorry, I can't help. I do think CRA, even more so than IRA and other, these big federal programs, which are going to have a real effect and still coming into effect. But I still think CRA is still going to be the big driver for a lot of this work. And I think CRA can also drive a lot of the environmental policy stuff through that system. I haven't seen it yet, but I think it's going to come.
Yeah.
Hi, so my name is can't say this. My name is Phil Swander. So prior to SOM, I actually bought some CPAs in my last job at Barron's. So how has it been difficult given the rate environment, given the lack of gain on sale, like when you're trying to sell to investors? Where do you find the investors who are willing to take the CPAs even if the rates are maybe a little bit below market in terms of what the building is actually paying?
Sure. So there's a lot in there, but basically the reason investors like CPACE, for those who aren't as familiar with the asset class, is that I mentioned we've got a tax lien securing our financing product. So rather than having a mortgage as your security interest, we've got a tax lien. What that means is we have a higher credit quality underlying our loans because we essentially can enforce our loans in the case of delinquency as though we were the government. So we've got like a big stake, we can foreclose. So what that means is the cash flows that come off of the CPACE loans that we make are attractive to any investor who has a low risk appetite. So we have tended to go to U.S. insurance companies, that they have been the bankers of our first fund. We have done public securitizations where you're selling off the rated notes. So you get a rating agency to rate those notes and how likely they are going to be paying for the 20-year term. And it tends to be attractive to a wide range of investors because there hasn't been that much CPACE in the market. I don't know if the statistic was exactly up there, but I think it was something like 5 billion or something of CPACE financing. That sounds directionally correct to me. That is not nearly as big as like the CMBS market where most mortgages are securitized. So there's been a little bit of a premium that I think you're referring to on the fact that there's just not as much liquidity in the CPACE market. So if you're an investor and you buy it, you're not exactly sure if you're going to have to hold it forever or if there's going to be a secondary market for it. That is pivoting a bit this year, actually, as we kind of get into larger transactions and we're seeing more CPACE volume out there. But there has been a little bit of a premium that investors expect when they buy CPACE loans or cash flows from them versus a more traditional mortgage product.
We've seen on the ground, we've seen a real, aggressive's not the right word, but a real meaningful push of larger loans in CPACE that we haven't seen in years. It went from $2-3 million loans, and now we're going to do an $18 million one, which is huge.
You said robust demand. Everybody says robust in an academic environment. It's one of our words. So it's robust.
But one question I have that piggybacks on that is like, I've never understood. So part of the whole dynamic of CPACE is that the banks have to seed their first position, right? Because now you've got dollars coming in front of them. And our hotel deal actually, it didn't get through the final credit committee, and one of the reasons why, and they've done CPACE, so I don't really understand what their reasoning was, but they said, one of the issues was that CPACE was making their loan more risky. So, how has that played out as it's been increasing? Have you seen more, banks, there's a set of banks who are like, we do CPACE, we understand it. And then there's a set of banks who are like, in front of us in the West.
Right. So I think you're right. And the thing that's being is that there are fewer banks that are just saying outright no because CPACE has become so prevalent that they're having to educate themselves about what it means. And they're not.
Peer pressure.
It literally is peer pressure. And they want to keep their client and their client wants CPACE. And if you've got a good transaction that you want to finance, you're going to have to figure out a way to get comfortable with it. And once they recognize that they can just underwrite into their cash flows the CPACE assessment coming ahead of them, they can figure it out. It's just another type of financing that's going on this property. I think where initially banks got worried about, oh, you're talking about an $18 million loan, you're putting $18 million ahead of me and kind of pushing down my position. That's not actually the case because we can't ever call due that $18 million. We can only collect what's due in 2031 and 2031. It is very kind of small bites over a 20 or 30 year term.
The basic concept of CPACE, and I know maybe it's gotten to be a little more liberal, but the idea would be if you buy some solar panels and then the CPACE financing on that is $100,000 a year, but it saves you $200,000 on your energy bill, the bank is actually more secure. So, I think there is a story to be told as to why the risk is actually lower with CPACE.
Great. Yeah, one last question.
So my name is Evan. Prior to SOM, I was an Air Force civil engineer doing some mechanical design work. So question for Bruce is kind of like, how do you manage the different, subcontractors, sub-designers that you have under you, and like, who's actually originating the projects for that hotel project? Are you trying to help them become more energy efficient, or are they actually asking you for this design done?
Yeah, I mean, I think one of the reasons that you haven't seen as much of this is that decision-making, particularly with hotels, there's like 10 people, up and there'll be like a fund, and then an asset manager, and then a project manager, and then the architect, and then the engineer, and any one of them can say no to a new idea. In fact, they're all inclined to do something that's been done before, because the design professionals could, unfortunately, they're always worried about being sued for something that doesn't work. So there's a tendency, generally, with these complex teams to just replicate what's been done before, even if it doesn't make any sense. I think because I'm sort of at the top of the food chain with I'm the architect of record, design architect, I hire the engineers, I've sort of lead that process by select team members who are curious and are willing to innovate. And I'm open to any suggestion from anyone, even if it's new. But I think it does require sort of a different approach to building a team and leading it, as opposed to, I want to eliminate all risk, to, here's an idea, I want to pursue it, and help me realize it.
Well, so as Bruce said, there's a chance to write your own story in this space, and if Bruce is going back to learn about like sustainable design in hotels and gets certified at a different stage, like here's some different options of where you can get weird at the edges of things in between the School of Management, the School of Architecture, and the School of the Environment. Cameron is going to be a wonderful resource for you to sort of navigate this landscape if you're interested in it, because it teaches some of these core courses. But like, there's an opportunity, and as you can see from the people here, multiple opportunities to combine disciplines and play around while you're here to be able to come out and then be one of the individuals who is authoring something rather than reading somebody else's book. And I hope that you all can kind of connect, get a chance to chat with these folks, follow them online, their active presences. You can see all the work that they're doing. Really appreciate you all being here. And can you join me in thanking our panelists?